When you first start learning about asset classes, you're generally given a short list consisting of the following: stocks, fixed income, and cash. However, there are many more asset classes than that. Let's take a look at the general definition of an asset class. An asset class is a group of investments that have similar characteristics, similar behavior or return patterns, and are usually regulated in a similar manner. Note that similar does not mean exactly the same. With stocks, because they represent equity or ownership in companies, they can be volatile. They also trade on stock exchanges with specific regulations. Bonds tend to be less risky and offer less upside potential than stocks. They also don't individually trade on exchanges, but rather are traded directly between bond dealers who act on behalf of buyers and sellers. You can place a trade for an individual bond on BMO Investor Line, but it would be BMO's bond desk that facilitates the transaction, not an exchange. These two examples, stocks and bonds, show that not only do they tend to have different performance and risk characteristics, they follow different rules too. But let's look beyond just the big three asset classes of stocks, bonds, and cash. Real estate is another asset class. Direct investments in real estate are less liquid than stocks, bonds, and cash. In other words, imagine you owned an investment property like a condo that you rent out. If you wanted to sell that condo, you couldn't do it in seconds like with a stock. It would take months before you could sell it and get the cash from the sale. Real estate also tends to move in a different cycle than stocks or bonds. Infrastructure is another asset class. When you think of infrastructure, think of airports, rail networks, energy companies, highways, and bridges. These are all examples of things we need in society to conduct business and live our lives. Commodities are essentially raw inputs that we use in life. Agricultural commodities would be things like corn, wheat, and sugar. There are many metal commodities like gold, silver, copper, and bronze. An energy commodity would be oil or natural gas. Currencies can also be an asset class. Some investors actively engage in what's called FX trading, which stands for foreign exchange trading. They may be trying to predict the relative movements of currencies between certain countries. Cryptocurrencies are a fairly recent new asset class. They are so recent that regulations are still being developed for them. But some mutual fund and ETF companies have launched vehicles that invest in cryptocurrencies like Bitcoin and Ether through regulated investment fund structures that you can access through your BMO Investor Line account. These funds are highly speculative, risky, volatile, and certainly behave in different ways than other asset classes. There are a few reasons why understanding asset classes is important. Because members of an asset class behave similarly, it can tell us a bit about how those members might behave in general, for example, stocks versus bonds. Asset classes also tend to have their own market cycles. Some asset classes with the same risk and return characteristics might move in different cycles, such that when one asset class is going up, the other asset class might be going down or sideways. This difference in return cycles is important when it comes to portfolio construction, and we'll revisit this in more detail in the lessons on diversification and rebalancing.